This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
When's the last time you plugged in your Commodore 64 desktop, your Nokia flip phone, or dialed up the internet through AOL? Those first out of the gate can fade down the stretch. Up next, a lot to get to today in the markets, but a competitive shakeup in the AI space clearly deserves our attention. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Hope you all had a wonderful and happy Thanksgiving and, of course, happy holidays. A lot to get to today, but got to start by saying things have gotten a little better. A little better for diversified investors, patient investors, and dare I say it, value-conscious investors. November saw a lot of rotation. Of course, it's behind us now, but a lot of rotation, in some cases out of tech and AI, and more specifically, the more speculative high multiple AI into some areas that had previously lagged. So we know that for most of this year, it's been AI all the time, right? In fact, at one point, I think coming into November, something like 55% of the return in the S&P had come from three stocks, all AI-centric. But that's starting to change. Charles Schwab noted this week that over the prior 6 months coming into November, only 17% of the S&P 500 constituents had actually been outperforming the index itself. Since then, we're now up to about 36%. So still not great, but it is definitely getting better. And in fact, the S&P 500 X the Magnificent Seven, so the other 493 names, according to FactSet, just hit an all-time high a week ago, last Friday. So we're certainly seeing slightly better halitosis, if you will. Bad breath, right? In fact, there's a technical indicator that I have followed for a number of years called the Whaley breadth thrust. When, I won't get into all the specifics, but it's when you see much broader participation in the S&P upside. When you see that trigger in the past, going all the way back to 1960, this is according to Subu Trade, going all the way back to 1960, it has been a pretty bullish signal for overall S&P 500 performance. In fact, of all the triggers, again, going back to 1960, 6 months later, the market was up an average of 15.05%, according to them, with only one negative result, and that was January 6th of 2009, which of course was still near the trough of the 2008 financial crisis. 1 year later, positive 100% of the time since 1960, with an average return of 22.85%. So, obviously, as I always say, past performance is no guarantee of future results, but broader breadth, if that's the way to put it, generally is a good thing. Let's just put it that way. But again, if you kind of dig under the surface, we saw a lot of the areas that had been lagging previously start to do better. Case in point, healthcare. 6 out of the 7 months prior to November, information technology had been far and away the best performing sector. Healthcare had been one of the worst. Healthcare was the best performing sector in November by a large margin. Remember, I've said it on the podcast for a good chunk of this year that the valuation discount of the healthcare sector relative to the S&P was pretty much the worst it has ever been, at least in the last 3 decades, but maybe ever. So maybe it's just reversion to the mean. Maybe healthcare underperforms going forward. But I've got to believe that once we get a little bit further past some of the uncertainty of the one big beautiful bill and some of the potential adjustments to Medicare and Medicaid, once we get a little bit more visibility into Kennedy Jr. and what he wants to do, we certainly have already gotten some visibility into how tariffs are going to affect the pharmaceutical industry. So we're getting past some of these obstacles that I think had tied up the sector. Just on a side note, I saw something from the World Health Organization just this week that global production capacity for obesity drugs is only enough for 100 million patients, with just short of 1 billion people living with obesity today. They predict that the obesity market, which is a nice way to put it, will double by 2030. So there are obviously other catalysts for the healthcare sector, but obesity drugs, Eli Lilly, Novo, some of those names, and a lot of the other players that are involved, there is a significant tailwind there that maybe that does something to reignite the healthcare sector in a more sustainable way rather than just a 1 month bounce back after some prior underperformance. We've also seen it at the asset class level. A very impressive month from small cap stocks. I don't talk a lot about smaller stocks. We do not own, full disclosure, a lot in our portfolios here at the Wise Investor Group. But it's something that we're going to have to take notice of going forward because at one point, the Russell 2000, which is sort of probably the best known small cap index, was down 7% at one point in November, only to finish the month higher and at an all-time closing high. So that was a very bullish reversal that I think offers a pretty good prognosis for the outlook going forward. You look at small caps, similar to what I just said about healthcare, they are trading at relative discounts to the S&P 500, not seen since the peak of the dot-com bubble. And of course, when the dot-com bubble popped, that kind of ushered in a much better 4 or 5 years for small cap stocks. Also, according to FactSet, small cap earnings, again, in aggregate, are expected to improve significantly in 2026 over 25. That might even look more attractive if this fourth quarter economic soft patch that we've had, leads to some short-term earnings revision downwards that maybe sets up for a better rebound in 26. And the other thing I would just mention is small cap stocks have traditionally been much more sensitive to interest rate changes than large caps. According to FactSet, interest expense as a percentage of total debt sits at roughly 7% for the Russell 2000, again, the small cap index, about 4%, give or take, for the S&P 500. So if, in fact, the Fed is going to be continuing to cut rates, it's a bit of an if, but let's say they do, theoretically, that could disproportionately help small cap stocks. So am I suggesting that you go out and load the boat on small caps and sell your S&P funds or your S&P names? No, I'm not saying that. But if you have been underweight the sector or have not even considered the sector, maybe it's something to start to take a look at. I know we will here at the Wise Investor Group. One caveat, Charles Schwab noted this week that since April 8th, 58% of the Russell 2000 that is profitable, names that have positive earnings growth, are up more than 19%. 40% that is unprofitable, up 46%. Okay? So what does that say? The most speculative names have done the best. Simply put. I would be very careful about that. I would probably fade that trade and maybe be a little bit more selective in your approach to small caps, either at the index level, the fund level, or the individual stock level. Maybe I'll offer some more color on that, as we get into 2026. We'll see what happens. Just in general, I know I've said it a few times. I think the big story this year, beyond the headlines, we all know about the headlines, tariff, Trump, the Fed. Beyond all that, the big story underneath the surface has been corporate earnings have been much better than just about anyone expected, right? And over longer periods of time, nothing drives stock prices more than earnings growth. Yeah, the Fed matters, inflation matters, politics, policy, they all matter. But over longer periods of time, nothing matters more than earnings. And now that we're about 97, 98% of the way through third quarter earnings reporting season, they're coming in at close to 15% year over year for the S&P in aggregate. Again, 2 months ago, expectations were calling for about 7%. This is according to FactSet. The performance was double the expectations. You don't see that very often. And 10 out of the 11 sectors in the S&P surpassed expectations on the bottom line. That is pretty darn impressive. And importantly, the historical trend is for earnings expectations to start high and then over the course of the year become a little more sober, be revised downwards. Well, earnings for next year, not only have earnings expectations gone up in the short term, consensus forecasts from Wall Street, but they've also been rising for 2026. As it stands today, again, according to FactSet, next 12-month earnings growth stands at about 12.5%, which is the highest level we've seen since January, and that's higher than expectations were, of course, before tariffs were even a thing. So rather than causing an earnings collapse, analysts think that earnings will actually be higher than before the tariff regime even started. Okay. I mean, that's pretty impressive. Now, take this all with a gigantic grain of salt, right? I mean, anything can happen in the economy. So these are just forecasts, right? Don't take this to the bank. But you can see why the market, stock prices have continued to do well when analysts are revising estimates higher, not lower. But here's an important point, very important point. The market's had a good year so far with the S&P 500's price-to-earnings ratio, PE ratio, staying flat. In other words, on January 1st, the market was trading roughly 24.5 times earnings, according to FactSet data. As of 2 days ago, when I looked at this, also roughly 24.5 times earnings. We have seen no multiple expansion, which means that pretty much 100% of the return on the S&P has come from earnings growth. Does that make sense? Right? So in other words, instead of people paying more for earnings than they did last year, we haven't seen that. It's just that the earnings growth has been double digits, and that's why the markets are up double digits. And looking into 2026, if you believe the analysts, which, you could choose to do that or not do that. But, I've been reading pieces from Deutsche Bank and, of course, our own firm, Raymond James, Merrill Lynch, Morgan Stanley, JP Morgan. I've been reading all of these. And the consensus is that valuations can stay at around their current levels. And a lot of the reason for that is, one, the Fed is likely going to be more accommodative in 2026, both through interest rate cuts. Remember, they stopped quantitative tightening. So there's that. But also, profit margins continue to be better than expected. And in fact, as of the most recent quarter, corporate profit margins are the highest they have ever been. Almost 13.5% on average for the S&P. Versus, again, according to FactSet, an average of closer to 8% over the last 30 years. So the profit margins are almost double now what the average has been over the course of the last 35, 36 years. So when you have lower interest rates, at least on the short end, okay, good profit margins, better than expected profit margins, potentially controlled inflation. I say potentially. A lot of people think that inflation could spike next year. I get that. But let's just say that inflation stays somewhere in this range. That's why analysts are saying that, hey, listen, we're probably not going to get much higher price-to-earnings ratios, okay, particularly in AI and some of the more growth areas of the market. But they're probably not going to be lower either. So if we do, in fact, get 10, 12, 13% earnings growth next year, there's the case for higher markets in 2026. What goes up does not necessarily have to come down. So keep that in mind. Obviously, very much related to this discussion, you can't pick up an article without reading about, or a paper or whatever you read, without reading about bubble, right? Everyone's talking about AI bubble. I mean, you read about it on the way to the airport, right? The cab driver, the Uber driver, everyone is talking about an AI bubble. But, I read a lot of the counter arguments, and the guys up at Ritzold Asset Management have been all over this. Barry Ritzold wrote a pretty good piece, and he was just saying, listen, by definition, it takes a crowd to create a bubble. His words, can you recall the public, the media, or even the Fed identifying a bubble on a timely basis? End quote. Asked differently, can investors rationally believe that prices are not entirely irrational? Well, if your answer is yes, chances are we're not in a bubble. Now, you know that old expression, right? Just because everyone has an umbrella doesn't mean it isn't raining. But I agree with Ritzold. I find it very difficult to believe that People who know literally nothing about the market, nothing about the economy, and I'm not dismissing the acumen of Uber and taxi drivers, but people who aren't experts, who aren't professionals, I doubt very much that they are accurately forecasting the starting and stopping of an AI rally. Let's put it that way, okay? I mean, just look in hindsight. We all remember the financial crisis, right? Well, if you consider trading volumes and percentage of mutual fund, inflows and outflows, all those things, there were very few people that bought the S&P or S&P 500 names in March and April of 2009. By October of that year, the move off of the lows was being called the most hated rally in Wall Street history. You fast forward 3 years to 2012, strategists were the most bearish they had been on equities, if you read the sentiment data, since 1985. So, obviously, that's an extreme example because you had a very deep trough and a very impressive rally. But virtually no one in the consensus thinking arena, whether it's analysts, media, the Fed, what have you, saw that the trough was in the spring of 2009 and that, we were going to rally essentially for most of the next 15 years. Nobody called that at the time. So again, to think that people are going to get it right this time around, I'm very skeptical about that. I mean, yeah, maybe we're in the late stages of the AI-driven bubble. We could just as easily be in a once-in-a-generation transformational technology boom that could drive the economy and the market for years to come. I mean, that's just as likely a possibility. I'm not saying it's our base case, but it's a possibility. So this idea that, what I was saying a few minutes ago, that profit margins of 13, 14% have to revert back to a much lower mean is not necessarily the case. And by the way, just to go back to this are we in a bubble idea, not only has the S&P 500 multiple not expanded this year, the technology sector multiple has not expanded this year. Compare that to 1999 or 2000 as we approach the peak of the dot-com bubble. It was much different. PE ratio, people were paying significantly higher multiples in the latter stages of that bubble. We are not seeing that right now. All the performance is really coming from earnings growth, at least at the index level. I know there are exceptions to that at the individual stock level. So, again, I have no idea, what the future holds any more than you do. But there are a lot of reasons to think that, yes, we may have corrections along the way. We may have pullbacks. Remember, it was just a few months ago in April of this year that NVDA went down 40%, right? A lot of the AI-related names went down more than that just in the last few weeks. Just in mid-October through Thanksgiving, a lot of those more speculative AI names were down 40, 50, 60%, particularly some of the quantum computing names. Bitcoin went down almost 40%. So the flushing of speculative excess can happen at any time for any reason. The market can be easily spooked, but that doesn't necessarily mean that you're going to have a protracted, sustainable downturn that's going to last for years, such as we saw coming out of the dot-com bubble. So keep that all in mind. I don't have much on the economy today. I will say this, that the fourth quarter was rough, right? We had a record-long federal shutdown. Of course, fears of an AI bubble that manifested in some rotation out of AI in November. We had credit cockroaches, right? We started to hear from some private credit firms about some bad loans. We had a stubborn Fed not wanting to cut, or at least being actually a little bit more hawkish for much of November. And then, of course, a wobbling U.S. labor market. But, in reading strategists and other folks who really follow these things, on a day-to-day, if not minute-to-minute basis, we're coming out of that soft patch. A lot of the more recent data, the data that we can capture, right? Some of the official data is not available, right? But at least the data that we can capture is looking up. And as I have noted on this podcast multiple times, as Strategas has noted, we're going to have significant fiscal boost coming the first half of 2026. In fact, the CBO estimates that the One Big Beautiful Bill will boost GDP growth by almost a full percentage point next year. One of the main factors is not just the bigger refunds, tax refunds that most individual filers are going to get. But also starting January 1st, businesses can immediately deduct capital expenses such as investments in equipment, research and development. That's a major tailwind for the economy. So as we get into next year, and again, we'll talk a lot more about this in further subsequent podcasts, Chase and I will, but the risks are probably less about an economic slowdown and maybe more about, inflation, coming back into the picture. So again, that's a risk for future me, as my daughters like to say. But I think the risks of a recession and a significant economic downturn, those have lessened. The inflation concerns have maybe picked up. We'll see. We'll see what happens. But I think hopefully earnings growth can still move forward even if inflation does become more of an issue. We'll see. The other thing I'll just say, and just keep this in mind, regardless of how good the economy could be, doesn't mean we can't have sell-offs. Strategists noted that if you look at the last 4 presidential cycles, the midterm year of the cycle, we've had an average of a 16% drawdown in the S&P. Okay? Average of S&P. Doesn't mean we finished the year down 16%, but an average drawdown at some point, most likely in advance of the midterm elections. And by the way, that has also, according to them, been the average drawdown in the S&P going back to 1928. So I don't even know if it has to be about an election cycle. I mean, that's the average downside. Now, if you look at the last 5-6 years, we've seen a little bit of both, right? This year, 2022, 2020, we saw drawdowns more than 16%. 24, 23, and 2021, less than 16%, right? So we don't know if we're going to be above average or below average next year. But I just say all this because you could easily foresee a situation where markets end up being okay, economy ends up being okay, but it's a circuitous, serpentine, volatile path over the next 12 months. You know what I'm about to say. Keep your discipline. Stay out of the speculation business. Keep some cash reserves for planned expenses, right? If you know you're going to buy a car, send a kid to Harvard, put a roof on the house in the next 6-12 months, let's budget for that, right? Let's have some cash, some short-term bonds, so you can ride out any volatility. But maybe it makes sense to keep the long-term positioning either as it is or at least rebalance back to a target, right? There are a lot of people that maybe 2 years ago were 60-40, right? Well, if you haven't done a single trade, you might be 75-25 now because stocks have done well and bonds have done okay, but not as well, right? So maybe some rebalancing is prudent. But that's the way I'd probably be looking at things in a very general kind of top-down way. Obviously, we all need to make individual decisions and hopefully individual decisions in concert and consultation with people like me, financial advisors. I want to talk just for a real brief 2 or 3 minutes about the housing market. I still get a lot of folks talking to me about real estate, and I'm not poo-pooing real estate at all. I have no problem with people going out and buying, obviously a primary residence, but second homes, third homes, for family enjoyment, even for investment. However, I would say 2 things. One, I think it's very important that folks take a real sober assessment what their return on investment is going to be. It's a little bit different if the return on investment is just going to be family fun, retirement enjoyment, okay? But if you're buying a second or third home as a investment and your main concern is how much money you can make, I'm amazed every week at how a lot of folks just don't take into account the carrying cost of real estate. And in many parts of the country, those carrying costs have gone up dramatically. We all know that insurance costs, I don't know about you, but it seems like my mortgage company every week is coming back to me, revising up the escrow that they need to withhold to cover insurance, right? We all know that utility costs are going up, and they're going higher as data center demand and other industrial demand takes off, right? We all know about maintenance. I hear all the time, people have a rental property, they're making money, they have good rental income, they have to put on a new roof that wipes out 9 months worth of rental income. We see this time and time again. So the first piece of advice I'll give is take a very sober mathematical assessment of what your liabilities will be, not just the rental income that you'll receive, okay? But the other thing is, for a lot of rental properties to work as an investment today, they really rely on the house appreciating for the numbers to work. In other words, based on what I just said, your actual, month-to-month cash flow may be, quite low. It might be, 2 or 3% return or less in some cases, maybe even negative in some cases. So you're basically banking on the fact that the house is going to go up in value to make it a good investment. Well, let's look at that for a second. Been reading a lot of interesting data, and a guy named Charlie Bolello, he's a financial writer that I place a lot of stock in, and I've read him for years and actually quoted him quite frequently on this podcast. He really referenced a lot of this. He was making the point that the share of first-time home buyers in the U.S. hit a record low of 21% this year. 21%. And relatedly, the median age of a first-time home buyer in the U.S. has moved up from 40 from 31 just a decade ago. Okay, completely different picture for young people and particularly young people with young families. Why is all this happening? Because this is far and away the most unaffordable housing market in U.S. history. It's not even close. As it stands today, the median household income necessary to purchase the median priced house for sale in this country is 57% higher than the current median household income. So, again, median household income necessary, about $124,000. Median household income right now is about $79,000. That is a gigantic disconnect, folks, because for years, decades, housing prices have moved up pretty much in lockstep with income. They're completely detached at this point. And again, as Bolello points out, home prices have increased by more than double the increase in wages over the past decade. Mortgage rates have also, of course, doubled over the past few years. You add it all up, guess what's happened? Home sellers are now estimated to outnumber buyers by over 500,000. The largest gap on record with data going back about 15 years. So what's the takeaway? If this holds up, these relationships that I've just been talking about, I think price appreciation in the residential housing market will continue to moderate. And we're already seeing it. In aggregate across the country, again, this is data from Bolello, housing prices have only gone up about 2% over the past 12 months. That's below the rate of inflation, right? There's some recent data from Case-Shiller, Redfin, Zillow that came out just this week. I guess it was November data. They all essentially point to the same message, a plateauing in housing prices. In fact, Case-Shiller said that year over year at the end, this was at the end of September. Year over year, housing prices only up 1.4%. And out of the 20 largest metropolitan markets in the United States, 10, half, are now showing negative year-over-year growth in housing prices. Meanwhile, renting a home is cheaper than paying a mortgage in all 50 of the largest metro markets in the United States. So I'm not going to belabor the point. There are a lot of, fallouts from this, particularly for our younger clients and the children and grandchildren of a lot of our retired clients. One of which, by the way, is we're finding a lot of younger people, because they're not even bothering to save for a home at this point. They're spending more, and in some cases outspending what they should be spending, and they're speculating more in stocks, cryptocurrencies, and what have you, because they're not trying to necessarily save a big nest egg in the bank. They feel they can take the money that they have and essentially go out and blow it, gamble it. So that's just one ramification of this. But going back to the investment thesis here, I'm not saying don't buy rental real estate. Of course, I'm not saying that. And as I mentioned earlier, I'm certainly not saying don't buy a second or third home. Just go into it with reasonable expectations of what your ROI, your return on investment, is going to be. If you're extrapolating out the housing price increase over the past 5, 6, 7 years and thinking that's going to be the case over the next 5 or 6 or 7 years, we all have those friends, right, that bought at the Outer Banks 10 years ago and now have doubled their money. If you're going in with those expectations, I think you're going to be disappointed. It's just my opinion. We'll see what the future holds. Just keep that in mind. I used the word sober a few times. Be sober when you're looking at your forecasts, if you will, and I think compare them to what you might expect from stocks, bonds, commodities, other asset classes. All right, I'll leave it there. Stick with me. In a minute, I want to come back, talk a little bit about what has become a horse race now in the AI landscape. Very interesting developments here just over the last 2-3 weeks that I want to make sure I share with you. Back in a minute. Fed job cuts are still on the table. The Wise Investor Group has your back. We help scores of federal employees develop solid financial plans, well-thought-out investment strategies, and are prepared for whatever happens in these uncertain times. Please find us at raymondjames.com/The Wise Investor Group, or just call us at 571-430-7200. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. I mentioned the idea of a horse race now in the AI landscape. Okay, as we know, for most of the last couple years, NVIDIA, I hate to mix metaphors, but NVIDIA has been the 800-pound gorilla, right? The dominant player in chips that essentially feed the development of AI programs and learning programs, right? We all know that. By the way, I should just say as a quick caveat before I get going, the names of which I'm about to speak are names that I actually own personally in my own portfolio. And we own in a number of our client portfolios here at the Wise Investor Group. You could consider that, and maybe should consider that, a conflict of interest. If you're a client and you own these names, I think you can feel comfortable that we've done our due diligence and feel that they're appropriate for you. If you're not a client, just remember that I can't manage your portfolio through the internet or through your podcast listening device. So make sure you do your own homework and determine that they're appropriate for your particular situation. But yeah, I mean, if you look at most of the last couple years, particularly this year, if you were to say that you were investing in AI stocks, well, I think everyone would kind of know what that meant, right? There was a stable of AI-related names. Maybe it's the Magnificent Seven. Maybe you could back out Tesla and Apple, add in Broadcom, Oracle, Dell, maybe IBM. And that was kind of the basic way to play the AI build-out. And I know people have speculated around the edges with data center operators and power generation and what have you. But if you just had a core portfolio like that, that was kind of the base case as to how you played AI. But it's really started to change. There's been a lot more dispersion here in the past few weeks, not only between perceived, I don't want to say winners and losers, but who might have the most competitive platform going forward, but also, of course, in terms of share price performance. You've seen some real dispersion. And maybe where the dichotomy is most evident is sort of the Alphabet / Google Cloud AI universe, and then the OpenAI / Oracle / Microsoft universe. Okay? That's where you're starting to see a real dichotomy. And Josh Brown over at Ritzold Asset Management broke this down into a pretty interesting chart, which of course I can't show to you, but I can read it to you. And he just kind of highlighted some of the differences. When you look at Google's architecture, the hardware primarily uses proprietary, what they call TPUs, which stands for tensor processing units. They have a cloud strategy, of course. That hardware is fully integrated with Google Cloud. Very cost effective due to vertical integration and proprietary hardware, what they call a full stack, right? All these things are vertically integrated through Google. And of course, Google is an established tech giant with vast resources, a very stable foundation, lots of free cash flow. And then you have the OpenAI, which looks less competitive, quite frankly, at this particular juncture. Why? Because their hardware is not self-generated. They use third-party NVDA chips, right? They have a multi-cloud approach where they use Microsoft Azure as a partner, but also Amazon Web Services and Google Cloud, by the way. Much higher operational costs due to reliance on those external partners. And versus being a legacy, well-established platform like Google, they're a rapidly growing startup seeking to build out a self-sufficient infrastructure. So I'm not here to say that Google is better than OpenAI. That's not where I'm coming from. But I will say OpenAI was considered the de facto leader and kind of just assumed that was going to continue to be the case. Google has really started to question that just in the past few weeks, really due to some recent innovations. So specifically, they just released their Gemini 3, which is essentially their upgraded learning platform. And it certainly improves on its predecessor's ability to create software programs, organize email, help business analyze documents. It can also mix graphics and text together, which is very interesting. So it can respond to requests involving travel itineraries, history, art. It's a significantly ramped up and much faster way for Google to essentially accentuate the impact of their search business. Because if you recall, as recently as 3 or 4 months ago, many analysts thought that Google was behind the curve, that their search business, we all know about Google search, right? I mean, Google's become, it's in the vernacular now, right? A lot of people thought that AI would crush their search business, but Google said, no. That's not the case. It's a multiplier effect for our search business. It accentuates, it enhances our search process. Well, this Gemini 3, the analysts that I've been reading are saying that it does exactly that in spades. And in fact, in terms of operational efficiency, scope, seems to be, at this point, more advanced than OpenAI, okay? And to the extent that the leadership over at OpenAI essentially said, as recently as this week, we have a code red, quote unquote. Code red in terms of we've got to get our act together in terms of innovation and coming out with our own new enhanced model. So you have that. But the other thing is that came out just in the last couple weeks is their hardware, those chips that I mentioned, those TPUs, they had originally just kept in-house, just used them to support their own programs. Now they're going to start marketing and selling them to other major hyperscalers and tech companies. Specifically, they just reported a potential hardware alliance with Meta, formerly known as Facebook. That was considered by a lot of analysts, including the analysts here at Raymond James, as a seminal moment where they've actually are selling that product. And in that sense, they certainly represent some competition to the NVIDIAs of the world. So I don't think it's an accident that in the course of 2 or 3 weeks, Google added almost $1 trillion in market capitalization. Even Berkshire Hathaway, good old Warren Buffett, his swan song in his last month as CEO, announced that they took a $4.9 billion stake in Google. First time they've ever owned Google, according to public filings. So you had the combination of Google's Gemini 3 termed a big threat to ChatGPT, right, the OpenAI platform, as well as the hardware side, where Google could be a potential threat to other chip manufacturers, probably a little less so NVIDIA, maybe more like people like AMD, Advanced Micro Devices. Remember that Google previously had also been held back by regulators. Well, those concerns are sort of dying away. Remember, earlier in the summer, the trust judge came out and basically said that Google didn't have to break up the company. They didn't have to divest Chrome or undergo any major transformational breakup or evolution to become more competitive with others. So they had that tailwind coming into this. Now they had the technology behind it. I haven't even talked about some of the other things that Google has going on, including a significant expansion of Waymo, their autonomous vehicle business. So there's just a lot going on there with Alphabet/Google. Now, by the way, this is, again, not necessarily an indictment of their competitors, right? I'm not down on Microsoft at this point or down on NVIDIA, and most other analysts aren't either. I think it's more a question of there's more competition in this space than there was a month ago, and it's still not completely clear who the leaders are going to be. And that's why in my very opening salvo here, I talked about Commodore 64, Nokia flip phone, AOL Internet service. Those were some of the earliest, companies to come to market with, or products to come to market in earlier periods of innovation. Cell phone, internet, right? Personal computer. We don't necessarily know who the leaders are going to be 3, 4, 5 years from now. So that's why, again, you want to stay diversified and also pay a lot of attention to valuation. It's very important to know how much future growth is being factored in to current share prices, right? If the assumption is that a certain company is going to be the dominant leader for the next 10 years, that might be already priced in today, and of course there's a lot of execution risk if that happens. I will say for Google, it's certainly not a deeply discounted value stock like I talked about to some degree a few months ago, but Evercore came out this week and said, listen, even with a 25% surge here, or more than that, over a 30% surge just in the last, couple months, it's still trading roughly 26 times earnings, which, with the S&P, maybe more 23, 24 times earnings. Google's only at a slight premium to the S&P, despite a pretty good runway into double-digit earnings growth and double-digit revenue growth. And again, according to Evercore, they have not only are those top and bottom line earnings and revenue targets pretty visible to Google, but they also have significantly higher monetization potential from their search business, YouTube, cloud, etc. So what does that mean? I think the risks is just what I've been saying. It's the competitive landscape. I assume that OpenAI is going to counterpunch, and maybe they'll come out with a more advanced model. We'll see. That's the risk. We just don't know who the leaders are going to be. We don't know what the future growth rates will be. But I think at Google's valuation, there may be a little bit more of a buffer there than with some of the other AI players. So, I don't know. Hopefully I was helpful. I know I kind of gave you a lot of information, technical information, in a very short period of time. But we'll see how this plays out over the coming months. I'll just say one last thing before I sign off here. Not to be outdone, Amazon, a little bit more quietly, to be honest, came out with their own AI chip upgrade, Trainium 3, which Amazon has said themselves, this is not coming from an analyst, they said themselves that they think it is far and away the best performing chip on the market, up to 50% faster processing speeds than some of the other chips available. So they are certainly, and remember their Amazon Web Services is already doing very well. I mean, that's the leader in sort of cloud software, but certainly Amazon has a much more competitive chip here. I think the other important takeaway from their announcement is not only is it potentially good for Amazon, but they still expect it to work in tandem with what NVIDIA is producing. So it's not a replacement for NVIDIA chips. Amazon said this themselves, that their chip can exist alongside the NVIDIA chips. So, not to repeat myself, I don't think this is an either-or situation, like buy Google, sell NVIDIA, or buy Amazon, sell NVIDIA. That's not really the takeaway. The takeaway is that the landscape is evolving, and probably some diversification, if you're going to be in those names, makes sense, because I don't think anybody knows, what 5 years holds from now is maybe not even 5 weeks or 5 months from now. Last thing I'll say about Amazon, by the way, I've spoken before. I think I referenced I believe it was a JP Morgan piece a few months ago saying that people have forgotten about Amazon's grocery business, their delivery business in some ways, sort of their legacy business. Well, they just announced 2 weeks ago that they're going to test ultra-fast delivery offerings in parts of Seattle, Washington, and Philadelphia, Pennsylvania, and essentially saying they'll be able to deliver household essentials and fresh grocery items, that's a quote, in approximately 30 minutes or less in those markets. So Instacart, which I don't really follow closely, Instacart shares went down, 5% on that news. But the other thing is Amazon is going to leverage it with their Prime model with a statement that Prime members will get discounted delivery fees. So remember, as you read about AI, you read about Amazon Web Services, don't forget about how competitive Amazon could be, or is, of course, but could be even more in that legacy business, particularly if they can do it while maintaining high profit margins. So again, as I said at the top, I'm not necessarily endorsing Google stock or Amazon stock. I just wanted to kind of frame the landscape a bit. But if you are interested in looking at those names for your own portfolio, make sure you do your own research. Those are names that we own in many of our client portfolios here already, and I own personally. Hope that was helpful. I know we covered a lot of ground here, went a little bit longer than I wanted to, but I'll look forward to be back with you in a couple weeks. I think Chase will be doing the podcast next week. Until then, as always, I wish you continued happy holidays and, of course, good health and wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.